Yes. In most cases, a trustee can sell a trust-owned life insurance policy. This video is educational. It is not financial, tax, or legal advice. Citizens Life Group is a licensed life settlement brokerage and is not a provider or buyer of policies. Reviewed by Jeff Hallman. When a trust owns a policy, the trust is the legal owner, and the trustee acts on its behalf. Three things generally need to be true. The insured is a senior or younger with a qualifying health condition. The policy is still in force, with a meaningful death benefit, and the trust document gives the trustee the power to sell or transfer trust assets. A buyer confirms that authority with a certification or affidavit of trust. One point to be clear about up front, this video is about selling an existing, in-force policy for cash. It is not about moving a policy into a trust or creating a new policy in order to sell it. That boundary matters, and it comes up again later. A trust holds a policy as its legal owner, and the trustee controls it, not the beneficiaries. There are three common structures, and the differences matter. In a revocable living trust, the grantor is usually also the trustee. The grantor keeps full control and can amend or revoke the trust. The policy stays in the grantor's taxable estate, and the grantor is treated as the owner for income tax, so selling is effectively the grantor's decision. In an irrevocable trust, including the irrevocable life insurance trust, the grantor gives up control, and the trustee owns and manages the policy. The structure is built to keep the death benefit out of the taxable estate by removing the insured's incidence of ownership under federal estate tax rules. These trusts are usually funded with gifts, often using crummy withdrawal powers, named for the case Crummy versus Commissioner, so the gifts qualify for the annual gift tax exclusion, which is $19,000 per beneficiary in 2026. If an existing policy was transferred in, the federal 3-year rule can pull the death benefit back into the estate if the grantor dies within 3 years. Survivorship policies, sometimes called second-to-die policies, are commonly held in these trusts and pay only after both insured people have died. Many irrevocable life insurance trusts were created for tax bills most families no longer face. Starting January 1st, 2026, the federal estate and gift tax exemption is $15 million per person and $30 million per couple. That amount was made permanent by the One Big Beautiful Bill Act and confirmed by IRS Revenue Procedure 2025-32, with inflation indexing from 2027. Far fewer families owe federal estate tax than when many of these policies were bought, in years when the exemption was a small fraction of today's. Here is the honest counterweight, because this is not a signal to drop the policy. 12 states and the District of Columbia still charge their own estate tax. Several more, including Pennsylvania and New Jersey, charge an inheritance tax that can start well below the federal level. And trusts hold policies for many reasons beyond federal estate tax: liquidity, special needs beneficiaries, charitable plans, generation skipping plans, and protection from creditors or divorce. The takeaway is to reevaluate with an attorney or CPA, not to assume the policy should go. The trustee, not the beneficiaries, generally holds the authority to sell a trust-owned policy. That power comes from the trust document and default state law. Under the Uniform Trust Code, which most states have adopted, a trustee may sell trust property without separate beneficiary approval for each transaction, unless the trust says otherwise. So beneficiary consent is usually not required. Even so, many trustees keep adult beneficiaries informed, and a written consent can lower the risk of a dispute when a sale changes what beneficiaries expected. The grantor's role depends on the trust. In a revocable trust, the grantor controls. In an irrevocable trust, the trustee decides, though a grantor who kept a swap power may be able to buy the policy out of the trust for equal value. A trustee who sells to the grantor still has to get fair market value, which is why shopping the policy competitively matters. If the trust limits the power to sell, there are 4 paths: beneficiary consent, decanting into a new trust, a non-judicial settlement agreement, or a court petition. And watch for one common snag. If the grantor has died, or the trust was dissolved, but the policy was never retitled, the ownership records have to be corrected before a sale can close. A trustee must manage a trust-owned policy like any other trust asset under a fiduciary duty owed to the beneficiaries. Under the Uniform Prudent Investor Act and the duty of loyalty in the Uniform Trust Code, a trustee is expected to monitor how a policy is performing and weigh the reasonable alternatives, which can include the secondary market. The American College of Trust and Estate Counsel puts it plainly. A trustee responsible for a life insurance policy must manage it just as it would any other trust investment. When an in-force policy could sell for materially more than its surrender value, prudence generally calls for the trustee to at least find out what that value is. Two fiduciary risks stand out. The first is a conflict of interest, such as a trustee who is also a beneficiary or who is tied to a particular buyer. The second is not acting prudently, such as not seeking competitive offers or not documenting the decision. Trustees typically show fair value by gathering competitive bids and an independent appraisal and then documenting how they decided. It helps to be precise here about who owes what. The trustee owes its fiduciary duty to the trust beneficiaries. A life settlement broker owes a separate fiduciary duty to its own client, the seller, which here is the trust, acting through the trustee. A broker who represents the seller does not replace the trustee's duty. It helps the trustee carry that duty out, and it creates the record. Specifics vary by state and by the trust document. A trust-owned policy sale is taxed in 3 tiers, and grantor status decides who reports it. Under Revenue Ruling 2009-13, as modified by the Tax Cuts and Jobs Act of 2017 and Revenue Ruling 2020-05, proceeds up to your basis are tax-free. Proceeds from basis up to the cash surrender value are ordinary income, and proceeds above the cash surrender value are long-term capital gain. The 2017 Act removed the old basis reduction for the cost of insurance, so basis now equals total premiums paid. That is more favorable than a surrender, where the entire gain above basis is ordinary income. Then grantor status. If the trust is a grantor trust for income tax, which is common for an irrevocable life insurance trust on the grantor's life, the grantor reports the gain on a personal return. If it is a non-grantor trust, the trust itself is the taxpayer, at compressed brackets that reach the top rate at a very low level of income, unless the gain is carried out to beneficiaries. On reporting. A life settlement is a reportable policy sale, so the trust may receive IRS, Form 1099-LS from the buyer, and Form 1099-SB from the carrier. A policy's prior transfer history can change the analysis under the transfer for value rule, so the trust's CPA should review it. And if the insured is terminally or chronically ill, the proceeds may be income tax-free under the viatical rules. As always, confirm everything with a CPA and a trust attorney before signing. Selling a trust-owned policy follows the normal life settlement steps with a few extra trust checks. First, confirm the trustee's authority by reviewing the trust. The buyer will request a certification or affidavit of trust. Second, gather the documents. The most recent policy or annual statement, the trust agreement and any amendments, a medical authorization signed by the insured, and photo identification for the trustee. Third, order an independent life expectancy assessment and shop the policy competitively to multiple institutional buyers. A broker who represents the seller runs that competition. Industry timelines average roughly 60 to 90 days from first contact to funds, and that is an average, not a promise. Fourth, review the competing offers and accept the one that is best for the beneficiaries. The trustee signs. Fifth, the proceeds are paid into the trust through escrow, and the trustee holds or distributes them under the trust terms. A rescission period applies after the seller receives the money, and its length is set by state law, not by a single national number. A quick note on who signs what. The trustee signs the sale. The insured signs the medical authorization. Beneficiaries usually do not sign. The broker's commission is paid from the settlement proceeds at closing, with no upfront cost to the seller, and only if the policy sells. Survivorship policies, special needs trusts, and dissolved trusts each add a wrinkle worth handling early. Survivorship policies often price higher for a settlement after the first insured has died because the remaining life expectancy is shorter and easier to measure. With a special needs trust, a policy may fund support for a beneficiary with a disability. If that need is met another way, or premiums start to strain the trust, selling can free up cash. But the priority is protecting public benefits, so a special needs planning attorney should be involved first. If a trust was closed or dissolved and the policy was left behind, correct the ownership records before trying to sell. Finally, keep the alternatives in view because selling is one option among several. A trustee can keep the policy, reduce the death benefit, move the cash value through a 1035 exchange, surrender the policy, or let it lapse. A competitive appraisal gives the trustee one concrete number, what the policy is worth today, to bring into the larger conversation about whether the trust is still needed. For scale, Citizens Life Group's review of the Life Insurance Settlement Association's 2025 market data shows life settlements paying an average of $212,000 against an average cash surrender value of about $24,000, close to 9 times more. Those are averages, not a promise. The only way to learn a specific number is to have the policy appraised.